Good morning, traders. Welcome to another analysis at Sven Labs. Before we start, stay until the end of the video because there will be a multiple choice quiz based on what we covered today. It's a quick way to test whether you're really understanding how liquidity, inefficiencies, and market structure work in gold. And if you find value in these daily breakdowns, consider subscribing for consistent XAUUSD analysis and trading insights. Now let's talk about the current market context. Right now, the gold market is in a very interesting technical situation. Price is currently trapped between two opposing 1-hour inefficiencies, which means the market is sitting inside a type of imbalance range. When price gets stuck between opposing inefficiencies like this, it often creates choppy and range-bound price action because the market is essentially balancing liquidity on both sides. At the same time, we have CPI news today, which is one of the highest impact economic releases for gold and the US dollar. CPI measures inflation in the United States, and inflation data has a direct impact on interest rate expectations, which then affects the strength of the dollar and safe haven assets like gold. This combination of technical compression and major fundamental catalyst is something we see very often before CPI releases. Markets tend to pause and compress before the news and then expand once the data hits the market. So today's analysis will focus on understanding the technical structure of the strap market and how CPI could trigger the next move. Let's break down the chart step by step. The first thing we do as usual is mark the previous day high and the previous day low. As you can see, we are on the day chart and we use the magnet. This will be a PDL, previous day low, 5117.3, and this is your PDH at 5238.7. This level defines the correct daily trading range. PDH typically represents buy-side liquidity, where stop losses from short sellers tend to accumulate, and PDL represents sell-side liquidity, where stop losses from buyers often sit. Markets frequently target these liquidity zones before reversing or continuing. Since price is currently compressed between inefficiencies, these levels can become important expansion targets once CPI volatility enters the market. If the market breaks higher, PDH becomes a natural liquidity target. If the market breaks lower, PDL becomes the next area where the market might seek liquidity. We now look at the daily time frame, where we can see that there are two FVGs in opposing directions which the market has been compressing between. Imbalances occur when price moves extremely quickly in one direction, leaving areas where the market did not trade efficiently. Over time, markets often return to these areas to rebalance liquidity. However, when the market is waiting for a major news event like CPI, price often pauses before fully fulfilling these inefficiencies. This is because large institutional traders frequently wait for high liquidity moments created by news events before executing large orders. So if CPI creates a strong move, it could easily push towards one of the higher time frame imbalance zones, which are day CB and a day BC. We now move on to the 4-hour. The 4-hour time frame helps us identify medium-term fair value gaps created during recent volatility. This is our range from yesterday, and we can see that the market made a very small BC over here. and we don't see any other. These zones often act as magnets for price. If the market begins expanding after CPI, these 4-hour inefficiencies can become important reaction zones where price either slows down or reverses. For example, if price rallies into a 4-hour fair value gap and rejects sharply, this suggests sellers are defending that imbalance. But if price fills the gap cleanly, it indicates the market is rebalancing the previous move. We now move on to the 1-hour, which is the most important part of today's structure. We can see that the market currently has two of them, which it's reacting from. The first being here, which is a sell side imbalance. Sell side imbalances push the market down. And when we look at our range, there is one which was formed here. So this is what I meant earlier when I said the market is trapped between two 1-hour inefficiencies which are opposing. One inefficiency sits above the current market price and one below. So this creates a situation where price can oscillate between the two zones, creating a range-bound environment. This type of structure is extremely common before major economic releases like CPI. Why? Because large traders are often waiting for a news catalyst to provide enough volatility and liquidity to break the market out of a range. Until that catalyst arrives, the market often moves sideways, trapping traders who try to force directional trades. So today the key observation is simple. If price breaks above the upper inefficiency, the market should begin expanding higher. If price breaks below, the market could expand lower. But until that happens, range conditions remain highly likely. We now look at the volume profile. Let us spot Monday, 1800 hours, Tuesday, and we mark it until 1600 hours when the day closes. It seems to not be showing the VH and VAL. So I will show you the settings for VH and VAL here. We mark it in red, the VAL. Here you put row size at 1000. This has to be ticks per row and extend right should be unchecked. So you can see the previous day's POCs at this level. This is the value area low. And we mark the previous day's value area high. So this is where we look at the previous day's volume profile. The most important level here is the point of control or the POC. The POC represents the price where the highest trading volume occurred during the previous trading day. This level is important because it represents fair value. When price moves away from the POC too quickly, the market often rotates back towards it. In a range situation like today, price often revisits the POC multiple times before deciding on a direction. So if the market remains trapped before CPI, we may continue to see rotation around this value. But if CPI triggers a strong breakout, price can move away from the POC and start trending. We now mark the psychological levels. Gold traders pay close attention to round numbers because they attract large concentration of orders. These levels often act as liquidity pools, support and resistance zones, areas where large players manage positions. When combined with liquidity zones and inefficiencies, psychological levels can become high probability reaction areas. You can see the 200 level was overlapping with the 1 hour BC, and you can see that the market has begun to react to it. Though we might have to see if it's going to sustain the up move or the reaction, but this is something you need to observe. Whole numbers include, let's say, 200 in this case, and since this is the range, 5 to 50 could be important, 5225 could be important, and on the lower side you can see the previous day's POC is near 5175. So if CPI creates a strong move, watch how price reacts when they approach these levels. A strong rejection might signal liquidity being absorbed, while a clean break can lead to continued expansion. So putting everything together, right now the market is technically compressed between two opposing 1 hour inefficiencies. This creates a range environment where prices may continue oscillating until a catalyst appears. Today the catalyst is CPI news. CPI often produces sharp volatility in gold because inflation expectations influence interest rates and the strength of the US dollar. So the most likely scenario today is compression before news, volatility during CPI release, and expansion after the market chooses a direction. That's why patience is extremely important on days like this. CPI days are known for false breakouts and liquidity sweeps. The market often moves quickly in one direction first, taking out stops before reversing into the real move. So instead of guessing the direction beforehand, the best approach is to let the news volatility settle, watch how price reacts at liquidity levels, and wait for structure and confirmation. Discipline and patience are essential on high impact news days. In closing, today's focus is to understand how technical compression interacts with major fundamental catalysts like CPI. Right now, gold is trapped between opposing inefficiencies, which means patience is key. Wait for the market to show which side liquidity is taken from, and then trade with structure and instead of guessing. Stay disciplined, stay patient, and I'll see you in the next analysis.